My name's Mark Cormack. I'm a director with Pinnacle Investment, and Pinnacle, as many of you will know, work alongside Solaris to distribute the Solaris investment capabilities to the Australian financial advisory marketplace. Apologies for the delay in our start. Today we're going to be joined by Solaris's Chief Investment Officer, Sean Martin, who's going to outline how they're navigating the current COVID-19 crisis and beyond in Australian equities. Whilst we only did a webinar a couple of weeks ago, it's really irrelevant, and the dramatic effects of Corona really bite into the Australian equity portfolios. In terms of background, as many of you know, Solaris have been an Australian equity manager and have been managing equities in the market for over 19 years, and they've outperformed in 16 out of those 19 years. Solaris adopt a style-neutral approach to investing in Australian equities, meaning they're not going to be held hostage to a growth or value style. And like all the boutiques within the Pinnacle suite, the Solaris team own the majority of equity within their fund management business. So before we start today's presentation, all attendees do have the opportunity to ask questions, and they can do that by clicking the questions tab on your screen. So without further ado, I'll hand you over to Solaris's Chief Investment Officer, Sean Martin, to take you through their presentation today.
Oh, thanks, Mark. 1 minute you're having Chrissy drinks, and the next minute everything's imploded with this weird thing that we'd never heard of before called COVID-19. And you know, markets are like that. The longest bull market in history means that something will happen, and it'll be an exaggerated effect because you go into it at such a lofty level of valuation. And that's what we've done. We've had, if you look at the next slide there, on slide 2, we've had a greater than 35% fall in Aussie equities in less than a month, and that's quite stunning. It's very rare to see that. In fact, we've done the GFC. GFC went from December 07 to March 09, and we've pretty much done that in less than a month. So it's very challenging for everyone, from healthcare workers to people worried about their employment, and indeed brutal to portfolios. What we see is raw panic in these environments. It creates a climate of maximum uncertainty, as I wrote there on to the right of slide 2. And we have an environment where you all but put your hands in the air and say, wow, what do I do next? That's actually not the right way to approach these things. The last image I've got there is the frightened scream, and that's sort of how I felt, I reckon, 2 or 3 weeks ago. And then you sort of sober up and you think about this. And as Mark so unkindly said, we've been through this before with a few scars on our back. And you know, there is one thing, if you look on slide 3 now and change the slide, one thing common to all these crises that I've listed, not all the crises there that are listed, that's just in my lifetime. I was born in 1969. So everything there has happened in my lifetime. Obviously, you could go back and start with, I don't know, tulips in Holland, I think in the 15th century. And, you know, there has been a history of this in not just markets, but mankind since the beginning of time. We get excited and exuberant. Irrational exuberance is what our man Greenspan used to say. And things get heated and they crash. And we all panic and it looks terrible. But the one thing every crisis, including this one, has in common is they end. And that is a powerful statement, because at the moment, markets are not pricing this crisis to end. Markets are pricing this crisis to be permanent or semi-permanent. And as a result, once you sort of come out of your fog and you realize that this is happening and that it's not going away, you get presented with this dichotomy. On one hand, you're faced with portfolios that are down 35% plus or minus alpha. And on the other hand, you're faced with amazing opportunities that we haven't seen since the GFC, because good companies that have in no way been have have a right to be caught up in this, get sold at fire sale prices. And so looking forward, it's actually exciting. I'm not in any way saying the health side of things and the human cost is exciting. It's horrendous. People will lose their jobs. People will get seriously sick, and the more vulnerable in the community at a rate around 2% who contract COVID-19 will lose their lives. And so I'm not in any way confusing things, but from a market perspective, there are opportunities everywhere, and Solaris is seeing opportunities thrown at them in the last 2 weeks like we haven't seen for 10 years, literally. So the question I always get asked is, if they end, when do they end? And we ask that question on the next slide. We have no idea when they end. And to be frank, it's not the right question. It really doesn't matter because it is all but impossible to predict. So why would we spend time focusing on that question? It's on the right. The right question is what is being priced, and what is being priced here, as I've repeated, is an unbelievable semi-permanent or permanent state of affairs, which is kind of ridiculous. I mean, you know, you risk the solution here being way, way worse than the problem. Someone asked me what we should do if this lasts for 3 years. Well, if it lasts for 3 years, we should probably all go back to work so that it doesn't have that effect, you know. And it's improbable that it'll go that long. I was actually researching this over the last little while, and the Spanish flu in 1918, it actually infected a quarter of the world's population at that time, an unbelievable number. And it killed 40 million people. It went for 2 years. So we need to have a little bit of perspective here. And if you can walk through the logic that we have a problem that is by definition short term, those of you who are literate in company valuation will say, okay, so 2 years is the outside, more likely 1 year and possibly less than a full year. Well, in a DCF sense, that is, if we're valuing companies as we should on future cash flows over many, many, many years, then taking out 1 year shouldn't have a large effect on valuations at all. Now, this is separate to companies that are directly affected by it, like travel companies, etc. But if you're just a residual member of the commerce community, then you've lost a year or less in your cash flows. That is not terminal by any means. And so what we now have, if you follow my logic, is a serious opportunity. The market is at peak fear. The market is in shock. The market is selling anything that has any problems, as if those problems will occur into perpetuity. And if we've just had a little bit of, you know, literally back of the envelope logic to say that's unlikely to occur, then we have a huge opportunity. And the medium-term prices, so in the medium term, the prices that we're seeing on offer for quality companies today will look, you know, absurdly generous. Now, there's a few caveats to this, because there is unfortunately going to be a percentage of the boards that won't make it. And so it must be quality first. You don't need to go down the quality curve here. You can buy Aristocrat on 11 times. You can buy Macquarie Bank on 10 times. You don't need to go down the quality curve. So you can buy quality companies at very cheap prices as long as they have a good balance sheet. And that's a really big disclaimer here. If you don't have a good balance sheet, one of two things will happen. You will either not make it to the other side and share the spoils of a post-COVID world, or you will only make it courtesy of a massive dilutive equity raising where new shareholders will benefit, not old shareholders. So with those two caveats, we are, in a market sense, seeing a plethora of opportunities that we haven't seen for so long. And it is incumbent on us as managers to ensure that we take advantage of this. And that might sound really obvious. But the reason I emphasize it is the easy thing to do in this environment is to buy Coles, buy Woolies, and buy Telstra and Hyde and bunker it out, you know? And we firmly believe at down 35 to 40%, that is the exact wrong thing to do. The horses bolted on that a long, long time ago. What you have an obligation to do at this point is to buy quality companies that have been indiscriminately sold, and that may not maximize short-term performance, but it will have a hugely positive medium to long-term effect on performance. So what is Solaris doing? We have a twofold attack. We are avoiding and shorting weak balance sheets, and we've seen that in the last 3 weeks. Some of the small cap stocks, they halve, and then they halve again. And it's the owner of Dreamworld, Ardent Leisure, Credit Corp, AMA, a whole range of, they get in a spiral where the market doesn't believe they're going to be able to refinance, and it becomes somewhat self-fulfilling. Next thing you know, your debt's 5 times your equity, and it's very difficult to get out of those situations. The travel companies, Flight Centre, Corporate Travel, Webjet, you know, it just seems like every day they're down another 20%. And with the number of quality companies trading at attractive valuations with good balance sheets, to be frank, you don't have to play that risk. You don't have to be involved in that level of risk. It is unnecessary. And you can have, you know, once in a generation, once in a decade sort of opportunities to buy Aristocrat at 11 times earnings. BHP the same, Macquarie the same. But it will not be a smooth ride. And so I caution you all, you have to have the willingness to buy Macquarie Bank, as we did the other day at $84, and see it at $71 2 days later, and buy more, you know. It then rose up to 95. So the level of volatility is so wild and almost unprecedented that you're getting very little information from the screen. Price discovery is no longer a tool. So you must see the price that you want, or wait for the price that you want, and take it. You know, if I were to frame a 3-year portfolio, I would buy Aristocrat, Macquarie Bank, BHP, Crown Casino, Tabcorp. I would short a bunch of the market, the big defensive darlings, and come back in 3 years, and I'm really confident that would make a lot of money. But there would be periods in the next 3 months where that may be down a lot. And this is where you need to be very strong, I believe, as an investor, and see the volatility at the moment for what it is. And it is indiscriminate. It is not reflecting the true company valuations that these franchises indeed are worth. And as a result, one must do the opposite. Just take advantage of it. The stock market at the moment is giving you a lot of misinformation. So if we go a little bit further, you would ask, I would ask if I was listening. So you've talked a lot of generalities. Give me some specifics. Well, you know, and some of these we've owned, so it's been quite painful. But if we have a bunch of opportunities, so the manic volumes that we've seen, and they really are quite unprecedented, have seen these quality franchises get belted way below their fair value. And Aristocrat and Star Entertainment Group are 2 examples. Aristocrat's down 65% since the 20th of February when this started. And that's on the basis that many of the land-based casinos in the US, where they provide poker machines, have been closed on a social distancing measure that we've seen in this country as well. And that obviously is not good for short-term earnings. Emphasize short-term earnings. Why should Aristocrat be down 65%? Because their short-term earnings have been affected. that is saying that those casinos should be closed to justify that for 5 to 10 years, and that's just most unlikely. And as a flip side, on the flip side, the other half of their business is digital gaming, and with everyone at home, that's going through the roof. So, you know, and with all due respect to COVID, I'm pretty confident that the gambling addiction will usurp. So that people won't seek out these entertainments is you know, bordering on absurd, to be frank. Star Entertainment Group has casinos, as most of you know, in Sydney, the Gold Coast, and Brisbane, and some of them are 80-year licenses. Again, re-emphasising where, in the scheme of their valuation, 1 year's cash flow, and that's assuming that these casinos are shut for 1 year. So the weird thing is that Star and Tabcorp historically would be considered good places to be going into a crisis, but not if they close them because of social distancing. So there's a lot of differences here to, dare I say it, a normal crisis. And as a result, one need not be so critical of how you found yourself into a certain stock or sector. The critical thing is to realize that it is a new world and you need to act according to the opportunities in front of you. And, you know, the middle of Feb, even Christmas seems an absolute eternity ago to me. And we've had this grinding bull market that's almost been hypnotic and meditative for what, since March 09. And in typical fashion, that's changed on a penny, and we need to adjust aggressively. And I don't mean aggressively by bringing heaps of risk into the portfolio. We just need to adjust aggressively in that yesterday's gone big time. And, you know, we have a whole new world. And this world is about identifying oversold quality stocks and identifying balance sheets that won't make it. It is not about looking at logarithmic tables to work out when COVID's going to end. I have no idea, and I don't think that's a good use of my time because it's such a moving feast. I just have faith, like the 10 crises before it in my lifetime and the, you know, whatever, 10,000 in humankind's existence, they end. They have a life cycle, and there's a great funds management saying is that buy the strike. If a strike in an airline causes the airline to miss a quarter's earnings, we were always told to buy the strike because it's not permanent. Exactly the same theory applies here. So if we look at a few other opportunities and landmines, that it is unique, COVID-19. It's seen some very unusual, but again, temporary outcomes. So defensive stocks, oh, fantastic. Let's have some Scentre Group. That's a defensive REIT. It's got, you know, the old Westfield centres in the best spots all over the country. Has a little bit of a headwind from online, and as a result, in February you were getting at a sort of 8% yield. Well, now you can, you know, it's an echo chamber, and you know it basically isn't a business at the moment. It's a warehouse, you know, with nothing in it, and it's hardly Scentre Group's fault. It's an outworking of COVID-19. So suddenly, the defensive stock that was meant to save you in a downturn is down 55%. So stop crying into your beer and move forward. What is 55% telling you? It's telling you that, you know, not only are you going to have a headwind from online, you're going to have an empty centre for the next 5 years. Like now, Solly Lewin Premier in a pointed, and I don't know how long have they been waiting to have a go at the landlord. it would appear a while. So they took great delight in saying we're out of here. But you know, these are prime bits of real estate, and we do not think Scentre Group is a sell at 55% down. It is a little bit vexed because quality might be questioned given how hard it is in retail centres. So let's move on to Atlas Arteria, down 40%. It's a French toll road. Sydney Airports has outperformed Atlas Arteria. I mean, Sydney Airports, last time I looked, was kind of in the line of the fire here. And a toll road through the middle of France doesn't quite have the same COVID-19 exposure as Atlas Arteria. That said, they're both very good assets, and we think both have been oversold. We just think Atlas is cheaper and has seriously attractive long-term fundamentals at this point. Now, the reason it's been sold down is again, the measures by the French government to limit the spread of the virus have included limiting some of the traffic on Atlas's road, and indeed the work from home wind down of France that we've seen in this country limits traffic. It's not a normal environment. People aren't moving around as much. But again, it's a savage beating by the market for what is a transient state of affairs. On the other side, weirdly, the iron ore price is held up because China's sort of back in business, so to speak. And so the cyclical stock that you'd expect to be smashed in a downturn like this, Fortescue, is up 5% in an absolute sense because of the way COVID-19 played out, with China being the first to both have a problem and the first to solve the problem. So they're sort of open for business, and that is Fortescue's customer. So yeah, there's every crisis has its nuances and its uniqueness, but I've just given you a whole range of three very clear examples where the expectation of protection in a downturn has been woefully inadequate. And as a result, I think you should be way more focused on how you're going to win over the next 2 years than you are on why you own Scentre Group going into the really predictable COVID-19 crisis. Well, of course it wasn't predictable, so every day's a new day. Find the stock that will win in the future. I mean, the next one I'm going to talk to is Fisher & Paykel Healthcare. I mean, wow, we call it the COVID darling. It was 50 times earnings pre-crisis. It's 65 times earnings post-crisis because they sell a few masks. That's a bit facetious. I'm not actually having a go at the company here. I'm having a go at the company's share price, just to be clear, and there's a big difference. They're trading like the next Apple here. They've got 5% compound EPS growth, but it feels nice if you're in there, and good luck to you. We just can't get near the valuation, and all the COVID-19 crisis has done is make the market more enamored with the share price. And these things change. I mean, does that sound familiar? Wax stocks, Afterpay down 85%. I mean, we were only talking at the summit in July how we couldn't justify Afterpay's share price. Well, at 85% down, we were really keen, and then it rallied 50% in 2 days, and yeah, didn't quite get the chance to get set. So you know, the volatility is wild, and we've got a situation where a lot of this volatility is being generated not from human beings but automatically, and so it maximizes the direction and the momentum, not momentum over 6 months, momentum day to day. And so again, it's incumbent on you to therefore do two things. The screen no longer gives you information, so trust your own valuation, which you should always do. And secondly, you need to be a little bit more aggressive in your execution. You can't afford to be cute with getting set, because yesterday's price can be long gone, and you know, stocks are moving 20, 30% in a day. Indexes are moving 5, 6, 7. When an index is only up or down 3% at the moment, we think it's a calm day. I mean, for most of the last decade, a 2 to 3% move was massive. So as a result, you've got to take opportunities when they come. You have to say, I like, what stock can I pick on that's been absolutely slaughtered? Let me think. Pinnacle. I like Pinnacle at $3. And every time it goes below $3, you rip in and you'll get about 10 shots at the title, you know, and you just turn the screen off. Don't get spooked by the screen. Whereas, you know, the sedate, meditative rally in hindsight of the last decade, you know, sometimes the screen then could give you a bit of information that maybe you weren't sort of aware of. Yeah, this is frenetic, manic, and a great opportunity to just do your own work, be very confident about where you see things in a medium-term state of affairs, and come back then. Don't look at the market day to day. And so if I was to except to take advantage of the $3 Pinnacle price, you know, it'll be $2.50. I think it got down to, what did it get down to this week? $2.20. $2.20, and I don't know if Ian's on the line, but it was $8 a little while ago. You know, what's really happened at Pinnacle over that period? Well, nothing. In fact, it's got stronger. So, you know, it just shows you that you shouldn't be listening to the share price. You should just, as an investor, you should be listening to your own valuation. And, you know, buying Pinnacle below $3, I should stop talking about Pinnacle because it's a bit out of school, but, you know, it's a wild old ride. But nothing's really changed that much for the company. So, and if we run through others, you know, Macquarie Bank's halved, James Hardie's halved, Tabcorp's gone down 70%, Treasury Wine and BHP Billiton. They're 5 stocks along with Aristocrat and Star City that we are either buying or adding to. They're either new positions or we've added to. And in all of those situations, every one of them has a good balance sheet, or as a minimum, not a stretched balance sheet. Every one of them has a quality product and some sort of IP or moat. And every one of them is giving you a valuation, an opportunity to buy it at an absolute steal compared to where it was less than a month ago. And so, you know, it's the curious thing about crises that if you were offered to buy any of those stocks at anywhere near those valuations only a month ago, you'd be so excited. Yet now everyone's so scared. And really the key here is to do the opposite. Don't get spooked. Don't panic. See the company's medium to long-term future as the crux of the valuation, not short-term earnings. And then I'll flip it around and say, what's been overbought? Well, you know, I had a fantastic picture of a toilet roll here, but it's a bit harder to sell that joke when there's no screen. But, you know, consumer staples are trading with, they've gone up because everyone's shopping at once and hoarding, and they're a safe place to be. And I don't dispute any of that. But we talked to Aldi the other day, and they're up 44% on PCP for sales. Well, that's not sustainable. That's ridiculous. Why would one, that's the opposite of everything I've been saying so far, is don't capitalize the negative information. Well, in these stocks, the very small minority of stocks that are benefiting, or at least relatively benefiting from the crisis, are being priced like, again, it's going to hang around forever. Parts of the health sector are the same. And one thing I can guarantee is when this turns, so too will that love affair. It feels comfortable to be in Woolies, Coles, Fisher & Paykel, Healthcare, Telstra. It feels comfortable at the moment. You feel comfortable being in those stocks that aren't being brutalized in their earnings from COVID-19, but it's already priced, and it's priced as if COVID-19 and this dislocated environment we find ourselves in, that enables these very companies to be in a relatively better position, is going to hang around for a period of time that it is just unlikely. So I was going to summarize it with a simple statement, and that's that when markets are greedy, be fearful, and when markets are fearful, be greedy. And it's not hard to work out where in that spectrum we are right now. It may be uncomfortable to be greedy at the moment, but indeed it is a fantastic time to do that. And I will quickly, as I feel like I'm repeating myself, put those two caveats on: by quality, short, wounded balance sheets, and I haven't talked about it here, but participate in capital raisings, because that's the third prong to our strategy. The GFC was very similar in that regard. If the biggest problem with your company is too much debt, then an underwritten equity raising that gets away is very attractive to participate in, because it solves the problem. And it couldn't be more simple than that. At that point in time, the very fact that you get the equity raising away is the positive. And often the companies have been trashed in a brutal cycle where everyone knows they need money, so they sell them in advance of that, and it spirals down. So you get these discounts that are quite stunning. So they're the three things that we're doing, and we'll be doing them for a long time, unless the V-shaped recovery happens faster. So I thank you very much for your attendance today. We're going to have some questions, but again, we apologise for some of the technical glitches. I think it's quite appropriate in this environment that's occurring, and we might send around the slide pack so you can have a look at those things. I'm going to pass you back to Mark now, and I look forward to answering some of your questions.
Thanks, Sean, and always great to hear your views on the state of play within the current market and get your ideas on portfolio positions going forward, especially considering it is such a fluid situation at the moment. And just a reminder that all attendees do have the opportunity to ask questions. We have had a number of them come in. You can do that by clicking the questions tab, and I'm getting those fed through by one of my colleagues. And as Sean mentioned, apologies, the slides were frozen on the Zoom system. We will send them through with a copy of this recording with the slides in what Sean was talking to. Before we turn to questions, as I mentioned, the Solaris team have been managing Australian equities for 19 years. They've outperformed in 16 out of 19 years. But importantly, the core of that investment team has been investing since the early 2000s. So they are experienced hands in managing portfolios in both up and down markets. And importantly, those senior members of the team have all been investing well before the GFC. So whilst these dislocations are uncomfortable, it's not new to the team, and it certainly does take experience to cut through the noise, assess the facts, and translate them into solid returns in terms of investments and alpha. Just in terms of questions, as I mentioned, we have had some come in. Sean, the COVID crisis, how do you compare the COVID crisis to the GFC in managing Australian equity portfolios? Any lessons that you've learnt that have helped?
Thanks, Mark. Well, there's lots of differences in terms of the nature of the crisis. One of my competitors slash mates said it the other day that the GFC was a financial-led crisis that corrupted the operating world, and this is an operating-led crisis that is corrupting the financial world. So very different in that regard. One was a, I don't know, freak of nature. The other's completely man-made. So, you know, and the list goes on, origins, etc. But it's not really that important. The differences to the crisis itself, because the similarities are how one takes advantage of the dislocated markets that ensue. And in that regard, it's frighteningly similar. The three tactics that we are using today are the exact same three tactics we used in the GFC. And just to remind you, you get sick of me saying it, you know, buy quality that has been indiscriminately oversold, participate in capital raisings where the overgeared companies fix their balance sheet, and where they don't, and those overgeared situations remain, avoid or short, and press repeat. You know, and we hadn't really thought of those things for so long, and suddenly in early March, when it was quite clear this wasn't going away, you know, we had a bit of a team chat as to the best way forward. And yeah, we were all coming up with exactly the same strategies that we used to good effect at the start of Solaris's existence. And, you know, there hadn't been that many capital raisings. I hope at that point, to this point, there's only been Omedia, Cochlear, and a smaller company whose second name is Revolution, but I always think Carbon Revolution. And without speaking out of school, that will change. There is a lot of capital that is going to be raised in corporate Australia in the next 1 to 2 months.
Okay, Sean, we've had another question come in similar. You know, overall, market has dislocated. How do you distinguish between value and what still has further to fall?
Well, that's a really hard question, excellent question. And the answer is that you don't try and be too cute. Buy quality, and if a stock has a problem, they have a problem. So the point being that you are getting such a fantastic entry price on quality stocks that have been oversold that you don't need to take the risk down the quality curve. So traditionally, it's not till the second sort of stage of the crisis recovery that one gets one needs to go down into, you know, smaller cap companies and companies with more issues. At the moment, you're getting fire sale prices for the best companies. So why do you even need to go down there? So that question becomes more relevant over time, less relevant right now. Right now, the price you're being asked to pay for very, very good companies is so modest that you don't even need to consider the companies with a few warts. So.
Excellent, Sean. Look, I'll summarise a couple of questions here because we've got multiple people asking different things. So, ideas on banks. We've got people asking ideas on resources. What are your thoughts on resources at the moment, and REITs? So, if you pop those into kind of 3 sectors for a summary, Sean.
Sure. If you want to just give me a list of the top 200, and I'll just go through stock by stock. Banks, they are much cheaper, obviously, and some of the headwinds from the Royal Commission have stabilised, I suppose. But it's pretty hard for banks when interest rates are so low because their NIM gets squeezed. But that's not the real reason we're cautious. The real reason we're cautious is their exposure to the economy, and we are currently, because there will be a period of dislocation in the economy, and unlike Aristocrat, the bank's exposure to the economy is magnified by their 1,200 to 1,500% debt to equity ratios. So when you gear 12 to 15 times, you know, that magnifies the pain. And I don't think this will happen, but if the crisis went on a little bit longer than one expected, and the unemployment rate was elevated for a longer period, it's undoubtedly going to be elevated, but for a longer period, then you start getting into the questions of the Australian chestnut, that is, will the property bubble burst? And there's no sector that wants that less than the banking sector. We think property in this country is incredibly expensive, but that hasn't stopped it being expensive for 20 years. So we haven't seen that. We're just a bit cautious about the leverage that comes to the banks with that in that period of dislocation. And the ROEs on the banks post Royal Commission, regulatory impost, lower monetary policy, competition, is down around 10, 11%. It's quite remarkable. So the rule of thumb is that you should, for financials, have a price to book that equates to your ROE, and you don't have a right to trade above book if you don't earn your cost of capital or greater. And, banks only really earn a little bit above their cost of capital now. So yeah, they are cycling bad and doubtful debts that are at record lows too. So, you know, we see the attraction in the valuation prima facie, but again, with so many other, so much more competition for attractive valuations, we don't really feel the need. We aren't as underweight as we were, just fallen a long way. Then REITs, I'll do resources last. REITs, you know, it's like false advertising. It's just every crisis they're meant to be defensive, and every crisis they implode. So like last time it's because they had gearing and went offshore, and yeah, this time there's a whole lot of reasons, and that's been pretty unfair because there are some very good REITs within that facetious statement I've just made. But you know, there's lots of property developers, lots of fund managers, there's lots of gearing, there's lots of external management that all gets lumped into REITs. So, you know, we've seen some of the more active REITs, so not just a passive collector of rent, like Stockland, Mirvac, be annihilated and have been anything but defensive. I don't know the REIT sector performance off the top of my head, but there's not too many winners, so it hasn't really held up to scrutiny. In fact, it was quite a strong performer on the way up and hasn't performed on the way down. So yeah, we own selectively own a couple of REITs, but we own them for reasons that are different to the attraction of the sector. We think Goodman Group is an attractive organisation on its own, irrespective of which sector it's in. So we tend to look at them, and then like, I don't know, a Bunnings Warehouse Group, like the REIT that houses all of the Bunnings. I mean, you couldn't get two more different companies, yet they're both REITs. So I think there's a breadth to both risk, there's a breadth to operation, there's a breadth to active versus passive now in that REIT sector that's so broad that it's quite hard to lump it in together. So we do like Goodman Group, and for our sins, we thought Scentre Group was good buying in the second half of last calendar year. So that's not really been helped by the fact that you could fire a cannon through every Westfield at the moment, not hit anyone. So yeah, so what do? Well, you just ask yourself, what's it being priced for? Is it being priced for that to occur for the next 10 years or the next 10 months? Well, it's more the latter than the former. Therefore, you keep the position. So yeah, I don't think the REITs are homogenous the way they once were. And it is so ironic. I did REITs a long time ago as an analyst, and you know, when I started, industrial sheds were the ugly duckling of the sector, and the retail behemoths were where you wanted to be. And it's not that long a period of time, 20 years, the exact opposite has occurred. Resources, always find resources to be, in any environment, the most challenging call that we are faced with, because their revenue moves up and down with a commodity that we don't think we've got much insight into picking. And that is augmented by the fact that they historically have been very poor at allocating capital, tend to make big acquisitions at the end of booms, tend to get all that free cash flow from the boom and make errant capex decisions. Interestingly, that hasn't happened this time, at least for the large diversified players in BHP and Rio. So they've been buying back their stock off market, on market, increasing their payout ratios, and looking more like industrial companies, and well-run industrial companies, even with ROEs going up. So we find it much easier to sit at that end of the resource quality spectrum. And, you know, it looks like the buyer of the products is going to be open before anyone else. So to that end, BHP, Rio, and the entire resources industry, if China keeps recovering the way it looks like it will, are going to be in a pretty reasonable position. But we do skew the resources positions to the larger end, And we actually have a couple of rules that unfortunately were born out of scars on our backs and failures, and we try to restrict the investments to either those diversified companies or Australian assets. We don't feel you need to go to the third world. There's enough good assets in the first world. You don't need to take that risk. We don't like companies in the resources sector that have a lot of debt. There's enough volatility with your income streams in that part of the economy to go out and augment that with a whole heap of debt. Prefer to be in the bottom quartile of the cost curve to ensure you make it through the downturn, and we'd like it to be in production, i.e. not a startup. And that doesn't leave you with many stocks, to be frank, and we don't have any problems with that. So we don't take huge macro bets in resources, and we are not doing that this time, but we are overweight. We do think that they are going to benefit more quickly and recover more quickly than the industrial cousins. And within that, we think the larger end of town is the more attractive, just because they've sort of learnt their CapEx lesson and are being quite responsible in how they're deploying free cash flow, in stark contrast to their histories. So with that, I'm sure you're sick of my monotone. I'll pass you back to Mark. I thank you very much for listening in, and you know, we are faced with many challenges, but many opportunities as well. So good luck out there, and again, thanks for your time.
Thanks, Sean. And look, we have run out of time, so we will wrap the Q&A up now. We will get to any questions that people have submitted, so please don't hesitate to keep submitting any questions, and apologies for those questions that we didn't get to. Look, I will just finalise by saying, you know, Solaris are one of those fund managers who truly back their investment capability, and they have a product which is a zero MER long-only fund, the Solaris Core Performance Alignment Fund, and they also have their very highly successful Solaris Equity Long Short Fund, which has been crowned Fund Manager of the Year with both Lonsec and Zenith. Available across virtually every platform, and as I mentioned, the team have outperformed in 16 out of 19 years. I certainly want to apologise for the lack of visuals today. Sean and the team put a great deal of effort in putting the visuals together, and they're disappointed to have not shown you, but we will send you through a copy of those slides so you can have a look at them later today. We'll have the Solaris website available with the webinar, so you'll be able to listen to this on replay with the slides in order. I do want to thank you for your participation today. Again, apologies for the visuals. We look forward to chatting with you next time on our next webinar as we keep you up to date in a rapidly changing environment. And if you want to refer to those slides, please don't hesitate to contact the Pinnacle distribution team or the Solaris website, which is www.solariswealth.com.au. Thank you very much and have a great day.